The stock market's gonna crash, sell everything, a bearish Armageddon doomsday scenario this way comes. That's pretty much in a nutshell what I'm seeing on mainstream media, on social media, and everything in between. As soon as we have a little bit of a red day, everyone freaks out. Folks, the TLDR of this video is basically this. Calm down, it's gonna be fine. We just hit an all-time high. It's more than acceptable to have a little bit of a breather. It's going to be okay. Now, for those of you who want more of the actual nitty-gritty detail, in this video, I'm gonna be giving you all the stats, facts, and figures of why exactly you should be staying calm and give you something a little bit more quantitative to base your trades off of rather than letting emotion really rule the day. If that sounds good to you, don't forget to like and subscribe. And with that being said, let's get into it. Here we are on Tuesday, July the 22nd, and the S&P 500 and NASDAQ retreat from record as chip stocks decline, and apparently that's enough to get everyone in a tizzy. As I'm filming this, you can see here, the S&P 500 just yesterday hit a new all-time high, but then the fact that it's a weird looking candle, it's getting everyone to panic. And I'm not necessarily talking about today's candle, I'm talking about yesterday's. Right here, the fact that we kind of popped up, came back, and closed pretty much where we opened, and also it's the low of the day. It's that candlestick setup, from what I can see, getting everyone to panic, and it's probably because they did a little bit of research. It's referred to as a gravestone doji, and really doesn't take much research to realize that everyone on the internet is calling this a horrific bearish setup. What is a gravestone doji? The term gravestone doji refers to a bearish indicator commonly used in trading by technical analysts. A gravestone doji is a bearish reversal candlestick pattern that is formed when the open, low, and closing price are all near each other with a long upper shadow, and that's exactly what we got. The open, the close, and the low all near each other with a big wick. That is the shadow that it's referring to. The long upper shadow suggests that the bullish advance at the beginning of the session was overcome by bears by the end of the session. This often comes just before a long-term bearish downtrend. As soon as people read that, as soon as that got really hold of the general public, people freaked out. This doji is a bearish pattern that suggests a reversal followed by a downtrend in the price action. A gravestone pattern can be used as a sign to take profits on a bullish position or enter a bearish trade. So with all of that in mind, I understand why people started to panic, because obviously the retail trading community is a very herd-like community. Someone starts to panic, it spreads, then everyone panics, and before you know it, you have a stampede. But don't forget, in the world of the market, it actually pays to ask questions. Even in the definition I was just giving you, there was a lot of like, it often does this. Well, don't forget, this is an empirical game. We can actually get exact odds, and that's what I did for all of you. Over the past 3, 5, and 10 years, looking at the S&P 500 and the NASDAQ 100, I looked at every single time there was an alleged gravestone doji, and I said, okay, how often do we actually sell off after? Give me the actual numbers, and yes, there was a little bit of variance between the S&P 500 and the NASDAQ, and a little bit of variance between the 3, the 5, and the 10 year, but guess what? The answer is kind of, but not really. 60% of the time, a gravestone doji leads to an actual sell-off. So is that better than flipping a coin? Well, yeah, that's 50-50. And we also know that the market is generally 50-50. I know this is a little bit of geek speak, but it's pretty much normally distributed. So technically, that is a slight edge in favor of the bears. But if you ask me, not enough to cause the entire market to panic because they saw one candlestick that makes them think that they need to sell everything. Yes, it is slightly bearish, but that's pretty much it. So now this begs the question, if that particular setup is only really a slightly better than a 50-50 shot, what should we actually be paying attention to get a better idea of the highest probability pathway from here to whatever, the next day, the next week, the next month, whatever time frame you trade? Well, I would argue pay attention to the key things that have been already moving the market. Numero uno is all the headlines related to the trade war. Trump says US struck trade and military deal with the Philippines, but they have not confirmed it. So if we get more and more confirmations, that's going to be good. If we get denials, that's not going to be so good. Also, don't forget that even though it's a quiet week, we do have major macroeconomic events. Wednesday, the 23rd, existing home sales. Thursday, we're going to be getting the interest rate decision out of the European Central Bank, normal initial jobless claims, and then we're going to get some PMI numbers. Friday, durable goods. None of of these are amazing. Really, if anything, I would bet people are gearing up for next week when we're going to be getting the results of the FOMC meeting, and basically Powell's going to give us a speech and also tell us what's going on with interest rate decisions. I would argue that's more impactful. And also don't forget about seasonality. This is on the newsletter, shameless plug, macros.locals.com. It's in the description of the video, but you can look at the seasonality of each individual day. So today, Tuesday, as I'm filming this, it is slightly bullish. Wednesday's neutral. Thursday, leaning bearish, and then Friday to conclude the week, also slightly bearish. So yeah, that's not also really the end all be all. You can have the stats, facts, and figures of seasonality. You could look at your technical setup, but don't forget, we could also see the positioning of the big guys, which I think is actually going to be the most influential. Basically, I'm looking at the SPY here, the current gamma setup, and what I see is basically 624 is the line in the sand, and if that snaps, it's going to be a quick push to 620, but also that's a big if. It could also serve as support, and then we can bounce right back to 628. So those are going to be the if-then statements. If we bounce, I'm looking for this. If we break down, I'm looking for that. And you could do a similar thing in the NASDAQ. This one's a little bit different. The fact that we're below 565 does tell me that maybe in the short term, the bears have a slight upper hand. But remember, this is a dynamic situation and it changes very quickly. And there is a decent amount of support in the low 560s. So if anything, I would say pay attention to the big guys. Consider the actual mass stats and figures of what's going on with seasonality, the actual candlestick setup, and then from there, maybe you have your best conjectures of news and macroeconomic developments. But the worst thing you can do is just let emotion lead the way when people are panicking for no reason and they can't even give you the odds of what they're trying to tell you to panic about. So as always, stay calm and let the math lead the way. That's what I have for you. Of course, if you have any questions, comments, or concerns, let me know in a comment below and I'll do my best to get back to all of you. That's what I have for you now. I appreciate all the good vibes. I'll catch you in the next one. Peace.